Right now, something is happening in the financial world that most people are completely misreading. My name is Zara, and I want your full attention for the next few minutes, because what I am about to share is not a trend or a short-term prediction. It is a pattern that has repeated throughout financial history, and it is repeating again right now in front of our eyes. Bitcoin just crashed to $66,000. For some people, that sounds like a disaster. For others, a buying opportunity. But for people who truly understand how money works, that number is a signal pointing somewhere else entirely. Somewhere older, somewhere more patient, somewhere far more reliable. That signal is pointing toward precious metals. Let me take you back to a moment in my own life. Years ago, I was completely focused on digital assets, watching charts every day, chasing momentum the way excited investors do when they believe speed is the same as intelligence. I put a significant portion of my savings into high volatility assets. I told myself I understood the risk. The truth is, I understood the opportunity. I did not understand the risk. Then the crash came. Not a dip, a real, deep, painful crash. The kind that does not just hurt your portfolio, it hurts your sleep. It hurts your confidence. I sat at my desk one evening, staring at the numbers, and asked myself a question I had never asked before. Where does money actually run when fear enters the room? That question changed everything for me. Because when I answered it honestly, when I looked at history instead of headlines, I kept arriving at the same place. Gold, silver, platinum. Metals that human beings have used as stores of value for thousands of years. Not because they are glamorous, but because they carry something no digital asset or paper currency can replicate. They carry trust earned across centuries. When Bitcoin drops sharply, it creates what historians call a fear cascade. People ask themselves, where is safe? Where is real? And increasingly, serious long-term investors are arriving at the same answer that has been true for 5,000 years. Value lives in things that cannot be printed, things that cannot be erased with a line of code, things the earth itself produced over millions of years. The $66,000 crash is not the end of something. For those who understand precious metals, this moment might be the beginning of something significant. Welcome back. Let me say something that most financial educators will not say plainly enough. The market does not destroy wealth. People destroy their own wealth by reacting to the market emotionally. When Bitcoin dropped to $66,000, what did the majority of retail investors do? They panicked. They sold. They locked in their losses and walked away, telling themselves they were being responsible, being smart. But they did not see who was on the other side of their trade. They did not see who was buying what they were desperately selling. I call this the Great Transfer. It happens in every single market cycle across every era of financial history. When ordinary investors panic and sell, sophisticated long-term investors quietly accumulate. When headlines scream disaster, the people who understand how wealth moves are not watching headlines. They are watching fundamentals. They are watching where fear is creating value. Right now, one of those places is precious metals. There is a concept in behavioral finance called loss aversion. Human beings feel the pain of a loss roughly twice as strongly as the pleasure of an equivalent gain. This is not a character flaw. It is biology. The same instinct that once kept our ancestors safe from physical danger now causes ordinary investors to make catastrophically bad financial decisions. When you see a falling number on a screen, your brain does not process it as an abstract financial event. It processes it as a threat. Stress hormones release. Your thinking narrows. Your time horizon collapses from years to minutes. And in that state, you make decisions that feel rational but are deeply destructive to your long-term financial health. The people who build real wealth have trained themselves to do something that goes against every biological instinct. When the crowd is afraid, they get curious. When the crowd is selling, they ask questions. When the crowd runs away, they walk toward it calmly and ask, "What is the real story here? Where is the value hiding underneath this noise?" And when they apply that discipline to this moment, when they look underneath the Bitcoin crash, they find precious metals waiting quietly, patiently, the way they have always waited for the world to remember that not all value is created equal. There is something called the flight to safety. When fear enters markets on a large scale, investors move capital out of high-risk assets and into assets that hold value regardless of what happens in the broader economy. Historically, without exception, precious metals have been one of the primary destinations for that flight. Think about why. Gold and silver are finite. They cannot be manufactured by a government running a deficit. They cannot be created by a central bank printing money. They cannot be hacked or erased. They are physical, tangible, and universally recognized as stores of value across every culture on Earth. Most people only recognize the flight to safety after it has already happened, after gold has already moved significantly higher. The skill is recognizing the early signals before the crowd figures it out. A sharp decline in a major speculative asset, combined with rising economic uncertainty, is one of the clearest and most historically reliable of those early signals, which is exactly what we are looking at right now. Welcome to part 3. Let me show you the evidence. Because everything I am sharing is not theory or opinion. It is history. And history teaches things that no headline ever will. Take the year 2008, the global financial crisis. Stock markets lost trillions. Banks failed. Fear was not just present in the market. Fear was the market. During that period, gold was quietly, steadily, powerfully climbing. And after the immediate shock passed, gold continued climbing for years, eventually reaching levels that seemed impossible to most people beforehand. Why? Because when the world lost faith in the financial system, when paper assets revealed their fragility, people needed something real, something that existed before banks and would exist after them. They needed gold. Move forward to 2020, the global pandemic, economies shutting down overnight, governments printing money at scales never seen in human history, interest rates cut to near zero, deep systemic uncertainty that most people alive had never experienced. Gold climbed to then all-time highs. Silver followed. Precious metals responded exactly the way they had always responded to periods of deep uncertainty. Here is the fundamental truth that history keeps confirming. Gold and silver perform well during specific conditions. When faith in paper currency is declining, when inflation is rising or feared, when geopolitical uncertainty is elevated, when major financial systems are under stress, when investors need something that holds value when everything else feels uncertain. Now look honestly at the world today. How many of those conditions are currently present? Faith in major currencies is being questioned in ways not seen in decades. Inflation has been a dominant concern across virtually every major economy. Geopolitical tensions in multiple regions are elevated. Major speculative assets are experiencing significant volatility. Ordinary investors everywhere are asking the fundamental question that always drives precious metals demand. Where is safe? These conditions are not just present. Several are present simultaneously, And historically, when multiple conditions align at once, precious metals do not just perform, they outperform. Now, something specific connects the Bitcoin crash to precious metals directly. When cryptocurrency experiences severe downturns, two things consistently happen. First, investors who held digital assets become extremely risk-averse. They want something stable, something that does not move with the violent speed of crypto markets. Second, the conversation about real stores of value intensifies. And when people genuinely ask where value lives outside the traditional financial system, the answer they rediscover is gold and silver. This pattern has now repeated across multiple crypto market cycles. There is also something happening quietly in the background that most ordinary investors are completely unaware of. Central banks around the world have been buying gold at rates not seen in decades. The very institutions that issue the paper currencies we use every day are quietly converting portions of their reserves into gold. If the institutions that print money are buying gold, what does that tell you about their confidence in paper currency over the long term? The evidence is not scattered. It is consistent. It is historical. And it is pointing in one direction. Welcome to Part 4. All of that history and context means nothing without practical wisdom. So let me be completely direct with you about how real people actually enter the precious metals market intelligently. First, an honest statement. Precious metals are not a get-rich-quick investment. They have never been that. What they are is something far more valuable. They are long-term stores of value. Financial insurance. The part of a well-constructed portfolio that holds its ground when everything else is shaking. When you understand them in that context, they become one of the most powerful tools available to an ordinary person building real, lasting wealth. The first principle is understanding before action. Most people skip this step. They hear about gold, see a headline, feel urgency, and jump in without truly understanding what they are buying or what role it should play in their overall financial picture. Precious metals should never be your entire strategy. They should be a component. The historically intelligent allocation is somewhere between 10 and 20% of a portfolio. This serves as an anchor, a stabilizer, insurance against the volatility that characterizes every other asset class. The second principle is understanding physical metals versus paper metals. Physical gold and silver, actual coins and bars you can hold, offer something no other form of precious metals exposure can match. True ownership, no counterparty risk, no institution that has to make good on a promise. The metal is yours. It exists in the physical world, and its value depends on nothing except what it actually is. Physical metals do come with practical considerations: secure storage, insurance, understanding the premium above the spot price that dealers charge. But for many long-term investors, that tangibility is worth every practical challenge. Beyond physical metals, exchange-traded funds that track gold or silver prices allow you to gain exposure through a standard brokerage account without storage challenges. Mining company stocks offer potential leveraged returns when metals prices rise. Each approach has legitimate advantages. The key is understanding what you own and why. The third principle is consistency over timing. The biggest mistake new precious metals investors make is trying to time the market perfectly. They wait for the perfect entry. They watch prices move and tell themselves they will buy on the next pullback. And then fear tells them it will keep falling, so they wait again. The solution is dollar cost averaging, investing a fixed amount at regular intervals regardless of price. If precious metals should represent 15% of your portfolio, you do not need to achieve that in one purchase. Build it systematically, a fixed amount every month or every quarter. This removes the emotional weight of timing decisions and allows you to accumulate your position gradually. The fourth principle is patience as a competitive advantage. In a world where every financial outlet focuses on what happened today, the investor thinking in years rather than days has an almost unfair advantage. The long-term performance of precious metals is not determined by what happens in any given week. It is determined by slow, powerful forces: global monetary policy, supply and demand, geopolitical reality. The fundamental human need for a reliable store of value. These forces move slowly, but when they move with enormous power. The fifth principle is that precious metals are not an emotion. They are a strategy. When you buy gold, you are not expressing excitement. You are making a strategic decision about the role of a specific asset class in your long-term financial plan. When the price dips after you buy, you do not panic because you understand what you own and why you own it. The people who fail with precious metals almost always bought emotionally and sold emotionally. The people who succeed approached it as a deliberate, long-term strategy and stayed committed through the noise. Welcome to Part 5, our final chapter. If you have made it this far, you are already different from most people. Not because of what you now know, but because you chose to sit still long enough to think. In a world that rewards reaction, you chose reflection. And that single quality is the foundation of every genuinely successful, long-term wealth journey. But I want to end with something serious, a warning that this entire conversation has been building toward. Here it is. The greatest threat to your financial future is not a crash. It is not inflation. It is not any particular asset performing poorly. The greatest threat to your financial future is the version of you that makes decisions based on urgency and fear, rather than patient understanding and long-term thinking. That version of you is not a character flaw. It is a biological reality made worse by an environment of constant financial noise, sensational headlines, and social pressure to have an opinion about every market movement in real time. The Bitcoin crash to $66,000 is real. The consequences for real people are real. If you are sitting with genuine losses right now, I want to acknowledge that this is painful. Financial loss is genuinely painful, and the emotions that come with it are valid. But here is what I need you to hear in the midst of that pain. Pain, when approached with the right mindset, is one of the most powerful financial teachers available. Not the pain of loss itself, but the question you ask in response to it. Where does money actually run when fear enters the room? That question, asked honestly, leads to history. History leads to gold and silver. And truly understanding precious metals changes the way you think about money permanently. Now let me give you the long-term vision. The world we live in is changing in ways that make the case for precious metals stronger than in previous decades. Governments are carrying debt levels that would have seemed impossible a generation ago. The digital world, for all its brilliance, has introduced new forms of volatility and new questions about what value really means. Against this backdrop, the finite, physical, universally recognized nature of precious metals becomes more compelling, not less. The supply of gold on Earth is not increasing at any meaningful rate. Demand from central banks, from industrial applications, from individual investors seeking safety remains robust. As populations in developing economies grow wealthier, Cultural and practical demand for gold and silver adds another powerful layer to an already strong, long-term story. This does not mean precious metals go up in a straight line. They experience their own volatility. There will be years when other asset classes outperform them. The intelligent, long-term investor understands this. They hold precious metals not because they will always be the best performing asset in any given year. They hold them because across multiple market cycles, across periods of crisis and recovery, precious metals have consistently done the most important job any asset can do. They preserve value. They protect purchasing power. They serve as an anchor of stability when everything else is shaking. So here is the clear takeaway. The thing I want you to carry into your financial life from this conversation. Do not simply react to the Bitcoin crash. Understand it. Ask what it is telling you about the broader landscape of value, risk, and safety. Follow that question patiently, with historical evidence as your guide, and let it lead you toward a more complete understanding of how a genuinely resilient financial life is built. Approach precious metals the way Part 4 described, with clarity of purpose, with practical discipline, with a long time horizon, understanding that you are not chasing performance. You are building something stable. Because here is the final truth this entire conversation has been building toward. Wealth is not built in moments of excitement. It is not built in the rush of a rising market or the panic of a falling one. Wealth is built in the quiet spaces between the noise. In the hours when most people are watching screens, you are reading history. In the moments when most people are making emotional decisions, you are returning to your strategy. In the years when most people are chasing whatever is performing best right now, you are holding what is real and waiting with confidence for the world to remember what real value actually looks like. That is the investor I want you to become. That is the investor that every great period of financial history has ultimately rewarded. The crash is not the story. What you do in response to the crash, that is the story. And that story belongs entirely to you. Write it carefully. My name is Zara. Thank you for being here. Thank you for choosing to think rather than simply react.